This is Rod Kusin, Spooman for Risk on February 4th, 2010. The Dow and the VIX. Well, today we're going to talk about the ES and the VIX. And we'll show you the Dow in just a few minutes. Let's take a look at some interesting things that have happened since we first started warning that this market is in store for some sort of a significant correction. Now, we had publicized back in the fall that a significant market correction was now overdue. We also had seen a gap on the ES, which you can even see right here. Blow that up, you can see that there's a gap there at 1095, roughly speaking. Okay, 1095. There's that gap. We finally filled that gap, not in October, but in the early part of November. That gap was finally filled, and the market rallied up on the S&P Futures to 1047, and from there it began to tank. Now, a couple of things about the trend line here. Now, this horizontal line was just to identify where the gap was, which you can see right there. But now look at the trend line. Now, using these two pivots for drawing the line, the market finally dropped below that trend line and continued to rally up. And if you've studied trend lines, you know that that's significant. The market rallies up below the trend line from what was previously the lows is now the highs. That's a very good indication of a market being ready for a correction. Market has come down. Now, sources, the pundits are making a big deal of the fact that the VIX is now above 25. Well, with all due respect, 25 is no significant number. It's been above 25. It's been above 27 already. The fact that it's now above 25 is of no particular significance. What's going to be significant is when it goes and starts to fill the gaps that are above it. We'll talk about that in a second. Now, so our point was that, yes, this market, as most of you who are involved in technical analysis would agree, market's been way overbought for some period of time. Finally, this correction has begun to manifest itself. Where are we going from here? There is the strong chance, and I would consider this to be strong because of just simply where the data indicates. We could get a rally back up here above 1100. We're down at 1060 at the moment, but it could certainly rally back up above 1100 before this market continues its free fall. But regardless, the big picture is what we're after. We want to talk about the big picture. So let me show you what the big picture is. We track gap data. And the gaps that are presently above the market are in fact way above the market. For example, we have currently a gap at 27.89, and this is based upon a 5-minute chart, by the way. So these are significant gaps. This isn't tick data. This is 5-minute data. 27.89. So that's why we say the VIX at 25 is of no particular significance. But your next gap is above 35. Now, we won't even talk about the gaps that are above that. But if you've watched our videos in the past, you know where the gaps are. There are significant gaps way above 40. That's the big picture. Now, we do have gaps below where the market is. to be sure. And we will certainly go down and fill those gaps. When? I don't know. But that we will is a certainty, because gaps are always filled. They just are. We've done study after study, year after year. They're just always filled. So, there is a major correction that could be taking place here. Now, where do we think the market is going to go when that occurs? Well, I know this may sound a bit ridiculous, but to be candid with you, I never had much confidence in the 700 level as being where the market was really destined to have some support. Now, the fact is, it did. And the market, of course, rallied up for an entire year. But just think about a couple of things here. If you look at the economic issues and you realize that the government has made a point in just this past week that a credible terrorist threat exists, and that an attack on American soil is a certainty within the next 6 months. What happened the last time a terrorist attack of significance succeeded? You saw a huge correction. So on the basis of just knowing that alone, what would happen if this were to occur? If a successful terrorist attack of significance were to occur, you would likely see the market drop right back down to 700 or less on the S&P. You would likely see the VIX catapult into the 40s and even the 70s, where gaps currently exist. Now, that's all I'm going to say. If you want to read the economic reasons for all of this, they are out there in quantity on the web. You can find plenty of resources that will tell you we are just as much in trouble now as we were in the fall. So looking at such things as the Baltic Dry Index, which is on its way down once again. And other sources from the Royal Bank of Scotland, which had predicted a retracement back down to 700 or less. We've got all of these resources that may not have been correct based on when the reports came out, but the economies have not changed. The probability that this market could come right back down to where we were in March, there's a very strong possibility that that could occur. So be very, very cautious. If you have not taken profits out of the market, by all means, you ought to have a stop on every financial instrument that you own. That is the only way to protect your profits if, in fact, you do not take profits out of the market. So we're not telling you what to do other than the fact, make sure you have a protective stop on all of your financial instruments. And that's my suggestion. I'm Rod Kusin, Spooman for Risk.